The idea of money that you cannot touch or hold is not new. For many years, smart people dreamed of creating a type of cash that existed only on computers. They wanted a system where people could send money directly to each other without needing a bank. This was a big dream because banks have always been in the middle of our financial transactions. These early thinkers imagined a world where you had full control over your own money, and nobody could stop you from sending it or receiving it. This digital cash would be fast, cheap, and open to anyone, anywhere in the world. It was a powerful vision of a more open financial future for everyone. These early projects faced many difficult problems. The biggest challenge was something called the double spending problem. Imagine you have a digital coin. What stops you from making a copy of that coin and spending it in two different places at the same time? With physical money, this is not possible. Once you give someone a dollar bill, you no longer have it. But with digital files, making copies is very easy. To solve this, creators needed a way to make sure that each digital coin could only be spent once. This puzzle was very hard to solve without a central company like a bank, keeping track of everything. In the 1980s and 1990s, a group of people called the cypherpunks tried to build this digital cash. They were programmers and privacy activists who believed that technology could give people more freedom. They created early forms of electronic money like DigiCash and e-gold. These systems were interesting, but they all had a central point of control. This meant that a single company or person managed the whole system. If that company failed or was shut down by a government, the digital money would become worthless. These early attempts showed that a truly independent digital currency needed a different kind of technology, one that was not controlled by anyone. The key idea that was missing was a decentralized ledger. A ledger is just a record of all transactions, like a bank's record book. A decentralized ledger would be a record book that is shared and updated by a large community of users, not just one company. Everyone would have a copy, and everyone would agree on what was true. This way, no single person could cheat the system or change the records for their own benefit. This concept, which we now know as blockchain, was the final piece of the puzzle needed to create a true digital currency. It was the foundation upon which Bitcoin would later be built, finally making the dream of digital cash a reality. In late 2008, a person or a group of people using the name Satoshi Nakamoto appeared on the internet. No one knew who Satoshi was, and to this day, their true identity remains a complete mystery. Satoshi published a 9-page document called Bitcoin, a peer-to-peer electronic cash system. This paper was a solution to the double spending problem that had stopped earlier digital money projects. It described a new system that used a decentralized ledger, which Satoshi called the blockchain. This was a brilliant idea that combined computer science, cryptography, and economics to create a form of money that did not need a bank or any central authority to work. Satoshi's paper explained how Bitcoin would work in simple, clear terms. The system would be a network of computers all around the world. These computers would work together to confirm and record every transaction. When someone sent Bitcoin, the transaction would be broadcast to the entire network. Special computers, called miners, would then compete to solve a complex math problem. The first miner to solve the problem would get to add a new block of transactions to the blockchain. This process made the network secure and ensured that all transactions were valid and could not be changed later. On January 3, 2009, Satoshi Nakamoto launched the Bitcoin network. He created the very first block in the blockchain, which is now famously known as the Genesis block. Inside this block, Satoshi left a hidden message. It was a headline from a newspaper, The Times, which read, "The Times 03 January 2009 Chancellor on brink of second bailout for banks." This message was significant. It pointed to the global financial crisis happening at that time and suggested that Bitcoin was created as an alternative to the traditional banking system, which seemed to be failing. It was a quiet but powerful statement about Bitcoin's purpose. The creation of Bitcoin was a quiet revolution. At first, only a small group of computer scientists and cypherpunks paid attention to it. They were fascinated by the elegant solution Satoshi had found for creating digital money. They started running the Bitcoin software on their computers, helping to build and secure the network. They mined new Bitcoins and sent them to each other for fun, testing the limits of this new invention. For the first few months, Bitcoin had no monetary value. It was just an exciting experiment, a piece of code that promised to change the world of finance forever. In the beginning, Bitcoin was more of a hobby than a currency. The first people who used it were technology enthusiasts who were curious about Satoshi Nakamoto's creation. They downloaded the software, started mining for new coins on their personal computers, and joined online forums to discuss its potential. The very first transaction between two different people happened on January 12, 2009. Satoshi Nakamoto sent 10 bitcoins to a developer named Hal Finney. This simple transfer was a historic moment. It proved that the network actually worked and that digital value could be sent from one person to another without any middleman. For over a year, Bitcoin had no real-world price. People exchanged thousands of coins for free, simply to experiment with the technology. The value was not in dollars, but in the idea it represented. However, for Bitcoin to become true money, it needed to be used to buy real things. The first time this happened was on May 22, 2010, a day now celebrated as Bitcoin Pizza Day. A programmer named Laszlo Hanyecz wanted to prove that Bitcoin could be used for commerce. He offered 10,000 Bitcoins to anyone who would order and deliver 2 large pizzas to his house. Another user accepted the offer, and the pizzas were delivered, marking the first ever real-world purchase with cryptocurrency. That pizza transaction was a turning point. It gave Bitcoin its first informal price. At that time, 10,000 Bitcoins were worth about $41. This showed the world that these digital tokens could be exchanged for actual goods and services. Soon after, small online exchanges started to appear. These were simple websites where people could buy and sell bitcoins for dollars, euros, or other national currencies. The first major exchange, Mt. Gox, was originally a website for trading fantasy game cards. It quickly became the biggest platform for trading Bitcoin, helping to establish a more formal market price for the new currency. As more people heard about Bitcoin, its value began to slowly climb. It went from being worth less than a penny to a few cents. And then, in early 2011, it reached parity with the US dollar. 1 Bitcoin was worth $1. This was a huge psychological milestone. It attracted more media attention and brought in a new wave of users, investors, and developers. The journey from a simple piece of code to a currency with real-world value was slow and steady. Each new user, each transaction, and each new exchange helped build confidence in the system, laying the groundwork for the massive growth that was yet to come. For a few years, Bitcoin was the only cryptocurrency in town. It was the king of the new digital world it had created. However, some people believed that Bitcoin could be improved. They thought it could be faster, more private, or have different features. This led to the creation of alternative cryptocurrencies, or altcoins. These new coins were often based on Bitcoin's original code, but with important changes. One of the very first and most successful altcoins was Litecoin, which was launched in 2011 by a former Google engineer named Charlie Lee. He wanted to create a silver to Bitcoin's gold. Litecoin introduced a few key differences. Its main goal was to be a lighter and faster version of Bitcoin. While Bitcoin creates a new block of transactions approximately every 10 minutes, Litecoin was designed to create a new block every 2.5 minutes. This meant that Litecoin transactions could be confirmed much more quickly, making it more practical for small everyday purchases like buying a cup of coffee. Litecoin also used a different mining algorithm, which was intended to make it easier for regular people to mine with their home computers, rather than needing specialized, expensive hardware. As the years went on, hundreds and then thousands of other altcoins appeared. Each one tried to offer something new or different. Some coins focused on providing greater privacy for users. Bitcoin transactions are pseudonymous, not completely anonymous. This means that while your real name is not attached, all transactions are recorded on the public blockchain and can be traced. To address this, privacy coins like Monero and Scash were created. They used advanced cryptography to hide the sender, the receiver, and the amount of every transaction, offering users a much higher level of financial privacy and confidentiality. The arrival of altcoins was incredibly important for the development of the crypto industry. It showed that blockchain technology was not just about Bitcoin. It was a flexible and open-source platform that anyone could build upon and innovate with. This explosion of new coins created a vibrant and competitive ecosystem. Different projects experimented with different technologies, governance models, and economic principles. This period of creativity and experimentation pushed the entire crypto space forward, paving the way for even more complex and powerful applications of blockchain technology that would emerge in the years to come. Section 5. Ethereum and the Smart Revolution. In 2013, a young programmer named Vitalik Buterin had an idea that would change the crypto world forever. He believed that blockchain technology could be used for much more than just sending money. He saw it as a kind of global, decentralized computer that could run any application you could imagine. You see, Bitcoin's programming language was very simple and limited on purpose, mainly designed for financial transactions. But Vitalik envisioned a new blockchain that would have a much more powerful and flexible programming language. This idea was the beginning of Ethereum, which he proposed in a white paper in late 2013. Ethereum was launched in 2015, and it introduced a groundbreaking concept called smart contracts. A smart contract is a piece of code that lives on the blockchain and automatically runs when certain conditions are met. Think of it like a digital vending machine. You put in a coin or cryptocurrency, and the machine automatically gives you a drink, which could be a digital asset or service. Because these contracts run on the decentralized blockchain, they are transparent, unstoppable, and cannot be changed by anyone. This removed the need for a trusted middleman like a lawyer or a bank to enforce agreements. The invention of smart contracts opened up a whole new universe of possibilities. Developers could now build decentralized applications or dApps on top of the Ethereum network. These dApps could do almost anything that a normal app on your phone could do, but without a central company controlling them. This led to an explosion of innovation. People started creating decentralized versions of social media, file storage systems, online voting platforms, and complex financial services. Ethereum became a global playground for developers who wanted to build a more open and transparent internet, often called Web3. The impact of Ethereum cannot be overstated. It transformed the blockchain from a simple system for recording transactions into a full-fledged platform for building new digital worlds. Its native cryptocurrency, Ether, became the second most valuable digital asset after Bitcoin. Ether is used as gas to pay for computations and transactions on the Ethereum network, making it the fuel that powers the entire ecosystem. Ethereum's success proved that the potential of blockchain technology was far greater than anyone had initially imagined, setting the stage for the next wave of crypto innovation. The years following Ethereum's launch were honestly a roller coaster for the crypto market. In 2017, the world saw the rise of initial coin offerings, or ICOs. This was a new way for crypto projects to raise money. Instead of seeking money from traditional investors, a project would create its own digital token and sell it to the public for Bitcoin or Ether. This allowed anyone to invest in new and exciting ideas from the very beginning. The ICO boom was, well, like a gold rush. Thousands of projects raised billions of dollars, and the prices of cryptocurrencies, including Bitcoin and Ether, soared to unbelievable new highs. This period of extreme excitement, often called a bull market, brought millions of new people into the crypto space. However, it was also a time of great risk and speculation. Many ICO projects had great ideas, but no real product, while others were outright scams designed to take people's money. When the excitement faded in 2018, the market experienced a massive crash or bear market. The prices of most cryptocurrencies fell by 80 to 90% or more. This was a painful period for many investors, but it also served as an important lesson. It cleared out the weak projects and forced the industry to focus on building real, useful technology. From the ashes of the 2018 crash, new and more mature ideas began to grow. One of the most important was decentralized finance, or DeFi. DeFi aims to rebuild the entire traditional financial system, like lending, borrowing, and trading, using smart contracts on blockchains like Ethereum. Instead of going to a bank for a loan, you could borrow directly from a pool of funds provided by other users, with the rules enforced by code. DeFi platforms offered a more open, transparent, and accessible alternative to traditional finance, available to anyone with an internet connection. At the same time, another unique idea captured the public's imagination: non-fungible tokens, or NFTs. While one Bitcoin is the same as any other Bitcoin, fungible, An NFT is a unique digital token that represents ownership of a one-of-a-kind item. This could be a piece of digital art, a collectible, a piece of music, or even an in-game item. NFTs became hugely popular in 2021, with some digital artworks selling for millions of dollars. They showed how blockchain could be used to create true digital ownership and scarcity, opening up new economies for creators and collectors around the world. As the cryptocurrency world matured, it began to attract attention from outside the small community of early believers. Big companies and financial institutions, which had once dismissed Bitcoin as a joke, started to take it very seriously. Companies like Tesla and Block, formerly Square, began buying Bitcoin to hold on their balance sheets, seeing it as a store of value similar to digital gold. Payment giants like PayPal and Visa started to integrate cryptocurrencies into their networks, allowing millions of their customers to buy, sell, and hold digital assets easily. This was, honestly, a huge vote of confidence in the future of the technology. Governments and regulators also began to pay closer attention. While some countries were hostile, others saw the potential of this new asset class. In a truly historic move, the country of El Salvador made Bitcoin legal tender in September 2021. This meant that Bitcoin could be used to pay for goods, services, and even taxes, alongside the US dollar. It was the first time a sovereign nation had officially adopted a cryptocurrency as its national currency. This bold experiment was watched closely by the entire world, as it tested whether Bitcoin could truly function as money for an entire country's population. Another major milestone came from the heart of the traditional financial system, the approval of spot Bitcoin exchange-traded funds, or ETFs, in the United States. In January 2024, the U.S. Securities and Exchange Commission, or SEC, approved several Bitcoin ETFs from major financial firms like BlackRock and Fidelity. An ETF is a type of investment product that can be bought and sold on traditional stock exchanges. This made it incredibly easy for regular investors and large institutions to get exposure to Bitcoin through their existing brokerage accounts without having to worry about storing and securing the digital coins themselves. The approval of Bitcoin ETFs was a landmark event. It signaled a new level of acceptance and legitimacy for cryptocurrency within mainstream finance. It bridged the gap between the old world of Wall Street and the new world of digital assets. The massive inflow of money into these ETFs helped push Bitcoin's price to new all-time highs. This institutional adoption, combined with growing retail interest and real-world use cases, showed that cryptocurrency was no longer a niche interest. It had become a globally recognized asset class and a permanent part of the modern financial landscape. After more than a decade of growth and change, it is fair to ask, why does cryptocurrency matter for ordinary people? At its core, the promise of a crypto is about giving individuals more control and freedom over their financial lives. In many parts of the world, people do not have access to basic banking services. They may live too far from a bank, or they may not have the right documents to open an account. With cryptocurrency, all you need is a smartphone and an internet connection. This allows for greater financial inclusion, giving people the ability to save, send, and receive money without relying on traditional institutions. Cryptocurrency also offers a powerful tool for people living in countries with unstable economies or oppressive governments. If a country's currency is collapsing due to high inflation, savings can be wiped out overnight. Cryptocurrencies like Bitcoin or stablecoins, digital coins pegged to a stable asset like the US dollar, can offer a way to protect wealth from being devalued. Furthermore, in places where governments can freeze bank accounts or block transactions for political reasons, cryptocurrencies provide a censorship-resistant way to move money. They ensure that individuals can maintain control of their assets, no matter what happens in their local political environment. Beyond personal finance, blockchain technology is creating new economic opportunities. The rise of DeFi and NFTs has allowed artists, musicians, and creators to connect directly with their fans and monetize their work in new ways. An artist can sell their digital art as an NFT and receive royalties every time it is resold, something that is very difficult to track in the traditional art world. Developers can build new businesses on open platforms like Ethereum without asking for permission from a large corporation. This fosters a culture of innovation and entrepreneurship, allowing new ideas to flourish from the ground up. Of course, the world of crypto is not just about finance. The underlying blockchain technology has the potential to make many systems more transparent and efficient. It can be used to create secure voting systems, to track goods in a supply chain to ensure they are authentic, or to manage digital identity in a way that gives users control over their own data. While many of these ideas are still in their early stages, they point to a future where power is more distributed and where individuals have more say in the systems that govern their lives. The importance of crypto lies in this promise of a more open, fair, and decentralized world. The journey of cryptocurrency from a simple idea to a global phenomenon has been remarkable, but the road ahead is still filled with significant challenges. One of the biggest hurdles is regulation. Governments around the world are still trying to figure out how to handle this new technology. They are concerned about its use in illegal activities, its potential to destabilize traditional financial systems, and the need to protect consumers from scams and high volatility. Finding the right balance between encouraging innovation and ensuring safety is a difficult task, and the future rules and laws will play a huge role in shaping the industry's future. Another major challenge is scalability and user experience. For cryptocurrencies to be used by billions of people for daily transactions, the networks need to be able to handle a huge volume of activity quickly and cheaply. While newer blockchains and so-called Layer 2 solutions are being developed to solve this problem, many networks can still be slow and expensive to use during times of high demand. Furthermore, using crypto can still be complicated for beginners. Wallets, private keys, and gas fees can be confusing. Making crypto as easy to use as a credit card or a traditional banking app is essential for mass adoption. Environmental concerns have also been a major topic of discussion, particularly regarding Bitcoin's proof-of-work mining process. The huge amount of electricity used by miners has led to criticism about its impact on the planet. In response, the industry is exploring and adopting more energy-efficient alternatives. The Ethereum network, for example, successfully transitioned to a proof-of-stake system, which reduced its energy consumption by over 99%. This shift shows a commitment to sustainability, but the environmental debate will likely continue to be an important issue for the crypto community to address. Despite these challenges, the promise of cryptocurrency remains as powerful as ever. The technology continues to evolve at an incredible pace, with brilliant minds all over the world working to build a more decentralized, transparent, and equitable financial system. The core ideas of self-sovereignty, open access, and programmable money are not going away. The story of crypto is still being written, and while there will surely be more booms and busts along the way, its fundamental technology has already planted the seeds for a profound transformation in how we think about money, ownership, and